Right now, AI is the thing, getting crazy valuations, mostly because we actually lack enough intelligence on the upside of those markets. So people are having FOMO, and they're just trying to make a lot of bets or really giant bets. In the alternative to the AI, which is still the majority, significant majority of the economy, you actually got to go and take a look at the rest. So how many other companies have gone and made successful business models such as yourself? If you are scarce that you've really done things well, you start having a premium. Welcome to a special edition of the Raise&Exit podcast, which might be the beginning of a new evolution in the format of what we do. And it is a recording of what I presented at the Silicon Y'all conference in the middle of October on how to go and take a look at valuation strategically. It is very much part of the passion of what I am part of, what we go and do at my company Avasta, and catalyst for the genesis of the Raise&Exit podcast. So some context for you. This is a room with almost 100 SaaS and tech services CEOs, a bunch of venture capital and private equity firms. And it's a walkthrough of how we go and take a look at strategic valuation, including a client case study. So view it as if you were a participant in the room and following along as I pause, as I ask questions. And even when I'm talking to the room and the recording that is there, just imagine it as if it was directed at you. I look forward to going and getting feedback from you on what this is. Part of it is at a high pace because of the time that I had available. So don't hesitate to go back and listen to it again. And I will be happy to answer any questions or comments that you go and put on this. And on that note, enjoy. So it's a pleasure to be here with you today. I'm going to dive right into this and kind of give you the articulation of what's here. And what we're going and talking about is, folks, we're going to play some football today. I think people in this room should know how to play football, or at least follow football. And what I'm going to go and share with you is just use that a bit of a theme as we go through today. So the majority of your valuation is dictated by forces that are outside of your control. Why? Because you are not in the business of selling your company. You are in the business of acquiring and serving customers that keep coming back, and adding to that beautiful ARR growth that some others have shared at this conference today. So it's informed by information that you don't have access to. Those environments are changing, and that's what I'm going to be walking you through today. So I want you to go and put your acquisition or investor hat on for a moment. And here's two companies. Okay, which one would you go and acquire? I don't know, like same revenue, same EBITDA. So you're missing some information. However, if I go and have a SaaS company and then I have a professional services company, are they worth the same? I'm seeing some head shaking. They're both churning out the same amount of EBITDA. Why? Because their commercial model, one is worth a lot more than the other. Nice rounded numbers. Don't start criticizing me on specifics right now, okay? All right? So what's going on is that 70% of your exit value isn't determined how well your business performs. It's determined by factors that are outside of your control, but that you now can have access to. So why does this happen? So this happens because you're considering what you have, your financials. Buyers considering integration costs. You're considering industry average multiples because that's what you can see. They're looking at their transactional database. You are looking at publicly accessible benchmarks. Oh my God, that company just got sold for 19 times revenue or 47 times EBITDA. Oh my God, I'd be a billionaire if I sold my company for the same ratios. What are they looking for? Well, how do you perform relative to my portfolio? Oh, but I got a great pro forma forecast that shows it will be a billion-dollar company. And they're like, yeah, but that's got to have some good timing to it. So it's not easy to solve this, but it is crucial to maximize your value. Because all of this is about you going in and having the intelligence that you need. So here's why. Why does this matter? Let's build on this example a little bit. Because you're actually not worth $35 million on a $10 million revenue multiple. Depends on who you're selling to. You might be at a discount if you're in a roll-up because you don't have enough strength in your commercial model to be the lead in a roll-up. Well, hold on a second. Some other private equity firm might go and say, hey, I really like what you're doing. I believe in your philosophy, and I'm willing to come along for the ride and work with you to cut the check. But then there's a strategic who might go and say, I like the synergy that we're able to go and have. So now we got 4 different valuation models for the same $10 million company with the same EBITDA. What the heck's going on here?
Well, the reason is there's no such thing as average. And as we've heard the term information asymmetry at this conference, that is crucial. You need that for sell-side advantage. Why? Because the private equity firms that you might go and sell to, or the strategics that you sell to, they are also wanting to make sure that they have that asymmetry for when they go to sell together with you in the future. So quarterly valuation discipline gives you your access to that same intelligence that buyers use to value money. Now, this used to be really expensive, but that is not the case. So we're kind of in this time bubble of looking at information of like, gosh, this was really hard to get. It was very consultative, proprietary databases. Those costs have come down a lot, and I'm talking about why it's important to invest into it. Because the best transactions align when your value drivers match with those of the buyer that is at the table. One thing that we always forget about also is this. You only see the transactions that happened and got reported on. You don't see the transactions when there were 6 bidders at the table at different valuations and different structures. The data from those 5 other transactions is never shown, but they can be considered. And they can be built into the valuation model. This is why you don't have one price for your company. You have a range of prices for your company. So I want to walk you through why valuation myths can cost you millions. And this is from a company that we've worked on over the past year. We initially started with them just to help them understand their own strategic valuation based on different scenarios. And then, well, 2 weeks after we finished our work, somebody came in and said, we want to buy you. And we helped them again. But let me walk you through why that matters. So what were some of the myths that we went and saw? Number one myth that we ran across was that they went and looked at industry average multiples to determine their value. So they were looking at their revenue, they were looking at their growth rate, they were looking at EBITDA, and they're like going and doing like online searches or ChatGPT searches, and they're going and seeing, okay, well, what else is kind of like, what are these companies being sold for? But they're only getting the public domain information. And so what does that look like? Well, here's some revenue multiples. Companies in your space are being sold for 0.8 times revenue and as much as 9.5 times revenue. Which one am I? Well, hold on. I'm going to go and take a look at EBITDA instead. Maybe that's a better guise for my business. Companies in my space are being sold for 1 times EBITDA up to 38 times EBITDA. Well, this is even worse in terms of a discrepancy. Which one of these companies am I? Well, let's go and just extrapolate a little bit more. Here's the reality. When you went and said that I went and looked online and got the average multiple, I got this. 2.2 times revenue or 12 times EBITDA. On which side of which average is my company? How did we come up with the average? Well, imagine if you had that intelligence. How many of you think that the company that was at almost 10 times revenue was also the company that was almost at 38 times EBITDA? How many of you think that's the industry North Star? Oh, you're smart. You're right. They're not the same company. The 38 times EBITDA company had 2.4 times revenue, and the 9 times revenue company had 27 times EBITDA. So you've got to be able to figure out how to go and navigate through the noise. So myth 1 is figure out what is actually setting the value in the base. So the next myth is the highest comp in my industry sets my ceiling. Well, that's not true either. How big of a deal are you talking about? Our client thought that they were worth less than $100 million. Well, this is the EV multiple range for companies that are sold for less than $100 million. Well, if we became worth more than $100 million, does that change our valuation? Which seems kind of like a paradoxical or a weird statement, but the answer is, yes, it does. Right here. You could be worth a lot more as a multiple, depending on the size of the company that you are, because of your fit. What's interesting is, in their space, really large transactions, revenue was no longer the driver again. So let's switch the topic. Let's go and take a look at, what else is going on here? Well, I'm going to go and look at the industry range that's there, and I saw some great deals in the market, and you're like, I loved what these deals went for. I'd like to go and sell what these guys sold for 2 years ago. Well, guess what? That's false reference. We had peak market, low interest rates, huge appetite. We're probably not going to see these multiples in your space for a very long time again. Maybe a little bit better on EBITDA, which wasn't as inflated. But again, you don't want to be out of sync with what is going on in the market and being able to understand the value of your business. This brings us to another key point. Seller is saying, well, I want to go maximize the amount of money that I get when I sell. The buyer is looking at, I want to maximize the amount of money I get after I buy it. They can be at a conflict. So you got to be able to take a look at and articulate what is the value creation potential of your business under new ownership, new investors, whatever it may be, not just going and looking at your historical results. There's a very strong bias that is how we went and looked at our valuations. Well, I look at my historical trend lines, and this is how we've been operating. We've been going up and up and up and up and up. How do you know if you've plateaued? So I'm going to walk you through the valuation drivers that's there. So going back to what are the three components of valuation today? Number one is your commercial model. Do you go and relate yourself as a SaaS company? In which case, what type of SaaS company? In which case, what's your recurring revenue period? All these factors come in. So you want to go and take a look at how much is your untapped demand in the marketplace. This is your combined winnable addressable market, something that Zane spoke to earlier, something I presented on last year. If people are interested, happy to share. You need to show how much runway is left on the other side of the transaction. Because if you've gone and squeezed out every single dollar from the market, you are not going to be attractive, regardless of how much profitability or cash flow you generate. Next, can you be integrated into a buyer if you're selling strategic? Can you articulate your defensibility and switching costs if you're selling to a PE? Next one, transaction appetite. How many deals are happening in your space right now? How many comparables are being sold? How many other similar business models are being sold? Is there froth in the marketplace and appetite? Right now, AI is the thing, getting crazy valuations, mostly because we actually lack enough intelligence on the upside of those markets. So people are having FOMO, and they're just trying to make a lot of bets or really giant bets. In the alternative to the AI, which is still the majority, significant majority of the economy, you actually got to go and take a look at the rest. So how many other companies have gone and made successful business models such as yourself? If you are scarce, that you've really done things well, you start having a premium. You also got to go and figure out what the timing is. One of the craziest things that we go and see in the marketplace is when there's a lot of competitive acquisitions, that's a good time to get in. Why? Because a lot of people just lost out on those deals. Remember, we only see the deals that closed. We don't see all the other bidders and what they went and put in. And if they're private equity or they're corp dev with a lot of capital that they have to go and deploy, they're still hungry. So that is why you got to figure out where that demand is. You being at this conference gives you an insight into that already. So the last driver is your actual business performance. And there's context to it. Because you need to be able to understand what your business performance is relative to other transactions that happen in the marketplace. So you can't just take a look at average revenue or average EBITDA multiples. You want to know where those transactions are. So for our client, over 75% of the deals happened in less than 2.2 times revenue. That's a really, really important consideration. It was very rare. There were outliers if you went and got to other thresholds. When you looked at EBITDA, over 60% happened in that second quartile. It was very rare that you went and got crazy EBITDA multiples. So being able to manage your own expectations, but also be able to push back at perspective or numbers that are coming to you from prospective acquirers or investors is just as critical. What you also want to go and take a look at is understand the range of what drives market timing and scarcity. I'm about to share some data with you which gets really kind of a bit more technical, but is one of the biggest competitive advantages that you're going to go and have. Here are the strategic acquirer multiples by quartile for our client space. The difference between 25th percentile and 75th is 3x. You need to know which one you fall into in the category and how to be able to articulate it. Revenue multiple, 4x. Private equity, lower premiums, higher floors. The key part is, if you're in the 25th percentile as a business, you're going to be at a huge discount. But if you become a top quartile business in your space, in your commercial model and how your business operates, the gap between strategics and PEs and the premium that we're willing to go and pay for you becomes non-existent, or pretty close to it. Why does that matter? Because you substantially increased credible value-generating, exit value-generating buyers for your business in the marketplace. So why does this matter? Because this is the conclusion to our client story. When we started working with them, they thought that they were worth about 70 million. We were able to go and get them to understanding what their valuation was in different scenarios. When that strategic came in, we were able to go and demonstrate why their narrative could be over 150 million. What's the challenge? Usually those numbers go down. Because they were already, they were able to validate their business model, they hit every single one of their 383 line items of due diligence to the satisfaction of the buyer. So what happened? Their valuation went up through the transaction because they were able to go and show this is how much business we're going to get while you're in due diligence with us. And if we hit these numbers, you're going to pay more. Guess what? They hit those numbers. What did the buyer do? They paid more. Why? Because they now got even more evidence that this company is able to do what it's able to do. So in the end, our intelligence helped them go and get over 90% increase in their valuation from what their mental model was internally that was not being contested by their external advisors that they were talking to, because those external advisors did not have this intelligence for themselves. So what can you go and control for yourself? You can go and control how you define your revenue in a way that can be credibly recognized by people who come and take a look at it. Don't lump all your revenue together. Break it out by contract length, break it out by revenue type, break it out by margin. Show more intelligence at the minimum to yourself and when you're ready to the prospective buyer. Build integration-ready systems. This is what we've heard about at this conference so much, is to be able to be ready to be acquired. Don't make it hard to be bought. Create defensible switching costs. This could be through satisfied employees, proprietary processes, process map for your business and how it operates. Get that market positioning intelligence that you need. Track the transaction appetite. You might say that you want to sell in 2 years. Well, what if the data in the market says that the best time is for you to sell now? Maybe you just take it. You at least have the option rather than going and saying, gosh, those valuations were great 2 years ago. Go and make sure that you're able to go and get multiple buyer types at the table. It's going to go and make it a lot easier for your investment bank founders if you're able to go and be attractive to more buyers. And time your transaction for maximum scarcity value. Sometimes it is better to go to market right after another deal has happened because so many of those people who missed the opportunity are still looking for a deal. Demonstrate that you're doing this, build repeatable value creation processes, and show that you're actually going and living into those. Demonstrate value creation and value optimization well before you start going into due diligence. So what do you need? You need your playbook. It's your systemic approach to value optimization. How can you go and show that we can predict what value milestones we can go and hit as opposed to demonstrate what we got historically? You want to go and get it into your 4 quarterly checkpoints. You want to, at the minimum, be updating a robust valuation model every quarter as your financials come in. You also want to go and take a look at your game film. Why did we achieve the results that we achieved? If we were ahead of forecast, why? Can we repeat this? Can we up our targets? If we didn't hit our target, get diagnostic and figure it out to solve it. The last piece that I'd kind of go and put into this that's critical is build your exit dream team. You do not need just your lawyers or your accountants or your investment bank. You need a series of other advisors and experts in the space that can go and articulate the value of your business in the marketplace to your prospective buyers. Lastly, maintain the discipline. By understanding what drives valuation outside of your business, it will help you to understand how you can use that intelligence to optimize articulating your value from what is happening inside the business. And that is going to allow you to win your exit championship. If you want a copy of this, got the QR code right here. Thank you.
Edgar, great job. Be ready for the music.